All right, let's talk trading. Look, we all know it can feel a bit like a high-stakes casino, right? It's exciting, but man, can it be intimidating. That line between a really smart investment and just a wild bet, it can feel incredibly thin. So, how do you make sure you're playing with skill and not just pure luck? Well, that's exactly what we're going to break down today.
This is the big question, isn't it? The one every single trader has to ask themselves honestly. You know that feeling deep in your gut when you make a move just based on a hunch, or maybe some hot tip you heard, and you're just kind of crossing your fingers and hoping for the best? Yeah, that's the feeling of gambling. And it's driven by the most powerful and frankly most dangerous force in the market, emotion.
And this quote from eToro, it just hits the nail on the head. The antidote, the cure for making these emotional, reactive decisions is having a plan. A clear, predefined strategy with exact entry points and, this is crucial, exit points. This is how you build a system that literally protects you from your own worst impulses.
So here's our game plan. We're going to go on what I like to call the trader's journey. We'll kick things off with your automated safety net. Then we'll get into how to actually calculate your risk. After that, we'll look at how you can test your strategy before you even think about risking a single dollar. And finally, we'll talk about becoming your own coach. So, let's dive in.
Okay, first stop on the journey is all about survival. Seriously, before you can even think about winning big, you have to make absolutely sure you don't get wiped out on a bad trade. This is where you set up your automated safety net. And the two most fundamental tools in your toolbox are the stop loss and the take profit. Now, they might sound similar, but they do completely opposite jobs. Think of it this way. One is your defense. It caps how much you could possibly lose. The other is your offense. It makes sure you actually lock in those wins when you have them.
Let's dig into the stop loss for a second. This is your line in the sand. You decide, before you even get into a trade, exactly how much pain you're willing to take. If the price drops to that point, boom, the order executes automatically. It just rips the emotion right out of the decision to cut your losses because you already made the choice with a clear head. It's your automated ejection seat before a bad trade can crash and burn your whole account. And on the flip side, you got the take profit order. This little tool is your best weapon against greed. I mean, how many times has it happened? You're in a winning trade, it's looking good, but you get greedy, hoping for just a little bit more, and then you watch it turn into a loser. A take profit order automatically closes your position at a target you set beforehand, turning that on-paper profit into actual cash in your account. But, you know, it's not always that straightforward. And this is where we get a little dose of reality, highlighted by this fantastic question from a Reddit user on the eToro subreddit. See, it's not just about your entry and exit points. You also have to think about the costs of just being in a trade, especially with certain kinds of products. And this chart illustrates that perfectly. For things like CFDs or contracts for difference, brokers often charge these small, daily overnight fees. They seem tiny, but look at this breakdown. A $10,000 position could rack up over $600 a year in fees alone, just for holding it. So your strategy has to account for these costs, or they can just silently eat away all of your hard-earned profits. Okay, so we've built our safety net. We're protected. Now we can shift from playing pure defense to playing some smart offense. This is where we really start to think like a strategist, and it all starts with calculating our risk before every single trade.
The main tool for this is the risk/reward ratio. It sounds kind of technical, but the concept is incredibly simple. It just asks one question. For every $1 I am putting at risk, how many dollars do I stand to gain if I'm right? That's it. And that simple calculation is the absolute heart of a good trading plan.
So how does it work in the real world? Let's just walk through this super clear example from Investopedia. Say you buy a stock at $20. You set your stop loss, your maximum risk, at $15. That means you're risking $5 per share. Then you set your profit target at $30, so your potential reward is $10 a share. You're risking $5 for a chance to make 10. That gives you a 1-to-2 risk-reward ratio. Simple. Now, that 1-to-2 ratio is a really common benchmark, and here's why. It means you can be wrong more than half the time and still be profitable over the long run. A lot of pros, as this source from Justin Trading points out, simplify this even further by thinking in R multiples. So if your risk, or R, is $5, a 2R target is just $10. It's just a clean, disciplined way to set your targets consistently.
So you've got your safety net. You know how to calculate your risk. But how in the world do you know if your strategy is actually any good before you start putting real money on the line? Well, welcome to the flight simulator for traders.
It's a technique called backtesting. And the idea is pretty straightforward. You take your trading strategy, all your rules for when to get in, when to get out, how to manage risk, and you apply it to historical market data. It's a way to see how your plan would have performed in the past. It turns a gut feeling into a data-driven hypothesis.
And this is the kind of thing a backtest can give you. This chart is called an equity curve. See that blue line? That represents just a simple buy and hold strategy for the S&P 500. But the green line, that shows how your specific trading strategy might have performed over that exact same period. Seeing a chart like this can give you the confidence you need to actually stick with your plan, even when you hit an inevitable losing streak.
We've covered the tools, the math, and the testing. But this final step, and you could argue it's the most important one on our journey, is all about continuous improvement. It's about becoming your own trading coach.
And your number one tool for that is a trading journal. Now, according to Notion's guide, a great journal tracks way more than just your profits and losses. It records the why behind every single trade. What were the market conditions? What was your emotional state? Why did you take the trade in the first place? By regularly reviewing this data, you can start to spot your own patterns, both good and bad, and you can systematically make your approach better over time. This is where real mastery is built.
So let's just quickly recap the journey we took. We started by building that essential safety net with stop-loss and take-profit orders. Then we learned to think like a strategist by calculating our risk-to-reward ratio on every trade. We built confidence in our ideas by backtesting them. And finally, we committed to mastery by becoming our own coach with a disciplined trading journal.
You see, this entire process is what transforms you from an emotional gambler, just reacting to the market's whims, into a disciplined strategist who has a plan. And the crazy part is, when you look at them, the tools themselves, stop losses, risk ratios, journals, they're actually pretty simple. The real question, the one you have to ask yourself, is this: is your discipline strong enough to use them consistently on every single trade? That's what makes all the difference.